Hello everybody, hope you guys are doing well. Today the video for today is about incomplete records, and I have taken out a question from the past papers. Also, this question is from a quite old paper. It's like May June 2011, and previously O level course code was for principles of accounts was 7110. Now it is 7707, the latest course code for O level accounting. And this is from paper 2 variant 2, also question number 3. So how do we identify it's an incomplete records question? Because the first line will tell you that Tanveer does not keep a full set of double entry accounts, which means that he does not have double entry, he has single entry. Single entry means that information is incomplete, and what they normally expect from students is that they want the students to make complete the information first and then make the income statement, and in some cases they also require the students to make a statement of financial position. So here they are telling you normally what they'll do is that they will give you a bank account and they'll give you opening assets and closing assets. So if you look here, they've given you a bank account, summarized bank account, which has all the receipts and payments. So payments are on the credit side, receipts are on the debit side. If you see the additional information, they've given you the assets at start, liabilities at start, and then they've given you assets and liabilities at end. Okay. So if you normally the thing is that students already know this, that the bank account on the debit side, you will have money coming in the business. So coming in the business, coming in and going out. So going out is the credit side. So payments are always recorded on the credit side, receipts are always recorded on the debit side. And then they have given you basically this, the first part requires you to calculate sales. So what you do is that you need to calculate sales, basically the revenue, the total revenue of the business. So basically total revenue, if you know, total revenue is not just cash sales. It can be cash sales like when you sell inventory and then you collect cash immediately. It can be credit sales like when you sell inventory, don't collect cash immediately. You basically your trade receivables promise to pay you in the future. So trade receivables are my current assets because these people owe me money. Okay, so credit sales, to find out credit sales, basically you need a sales ledger control account. I call it SLCA. So if you have studied control account, you would be able to use control account to find out credit sales. So control account, how does control account look like? Control account has trade receivables at the start, control account has trade receivables at the end, and then on the debit side, credit sales are recorded. So if you remember from control accounts, you basically need to know a bit of a format of control accounts, because control account is always a total, it's also a total of trade receivables account. So basically, whenever trade receivables are increasing, you record that on the debit side. Whenever they are decreasing, you record that on the credit side. So basically, you make this T account. You put a brought down of trade receivables on the debit side 9750, and you put a carried down of trade receivables on the credit side, and this will be 8400. And basically credit sales are recorded on the debit side because sales increase your trade receivable. That is why they come on the debit side, but you don't know what credit sales here is. However, you know what your customers paid you during the year. So whatever we received from our credit customers was 60,500, which we write over here, 60,500. So basically, if bank is debited, my trade receivable account should be credited, so that the double entry takes place, right? So 60,500 will come on the credit side. Now when you do 60,500 plus 8,400 minus 9750, you get 59,150, which is the credit sales here. Okay, I don't know what the cash sales is, but for the cash sales, if there are cash sales in the question, you need to see the debit side of the bank account. So debit side of the bank. So if the cash sales were directly paid into the bank, you would find them on the debit side of the bank account. So there's no cash sales. You just have receipts from customers, which your basically trade receivables, what they paid you. So we just have revenue here in the form of credit sales, which is 59,500. So you write here revenue is 59,150. That's it for sales. This is for 3 marks. Then they're saying in the next part, they're asking you to make basically calculate purchases. And purchases also can be of two types. It can be credit purchases. So when you purchase on credit, you buy the inventory and promise to pay in future. That those suppliers become your trade payables, and trade payables are current liabilities in accounting. And whenever you so credit purchases. You need to find out credit purchases by using a purchase ledger control account. And you need to find cash purchases you would find from the bank account. So credit side of the bank account will show the cash purchases if the business has done cash purchases. So when you make a purchase ledger control account, so basically I'm trying to calculate purchases in my next part. And for this, I need my trade payables at the start, which is brought down will come on the credit side for trade payables. So trade payables here are 10,500 at the start of the year. So you start with 10,500. And at the end of the year, your trade payables are 9,300. So you write here 9,300. Carried down. And then payments to suppliers that you have made. So payments to suppliers are always recorded on the credit side of the bank account. That is 34,900. So what you do is that obviously your trade payables need to be debited by the payments amount. So you write here 39,400 and you write here bank. And basically credit purchases always are placed here. So you write here purchases. And you basically find out purchases from the purchase ledger control account, which in this case is 33,700. This was basically not 39,400. This was 34,900. Okay, so we have 33,700, which is our credit purchases in this case. So we write here purchase ledger control account. And in the case of revenue, we write here sales ledger control account. And you guys can use another format as well. You don't need a format of a control account exactly, but you can do this, that you start with basically the payments that you have made to the suppliers plus the ending suppliers minus the opening suppliers will give you credit purchases. So you can just write it in a formula as well. It's not necessary, it does not require you to make a control account here, but control account I find very easy, and I think my students also find it easy. So we are done with purchases, we are done with revenue, but now what the thing is that the next part is saying that you make the income statement. So before making the income statement, why don't we complete the information, like what will be written in the expenses section? Would there be any incomes that will be added to profit? So if that is the question, would there be any incomes that will be added to profit? So incomes, if there are incomes in the business, right? So they should be recorded on the debit side of the bank account, because incomes are you'll be receiving money for incomes. So there are two types of receipts over here. One is receipts from customers, which we have used in the sales ledger control account. The other is the money that you have received from the sale of a non-current asset. So non-current asset here is when we have sold a non-current asset, you basically make a loss or a profit on that. So if it's a profit, you write it as an income and add it to the gross profit. So here they have basically sold it for the selling price of the non-current asset is 750, and the net book value. So if you look at the last part of the question, the non-current asset sold during the year had a book value of 1,000. So book value was 1,000, which means that I expected that I should receive 1,000 for the non-current asset when I sell it, but I received 750, which means it's a loss on disposal of 250 here. So basically that goes in the expenses section, and then we don't have any other income, because I know this because there is no receiving in the bank. If there was an income, we would have received money during the year in the bank account, and it would have been recorded on the debit side. So but we have expenses like payments to suppliers we have used for the purchase ledger control account. We have wages, we have lighting and heating. we have general expenses. So these are the expenses that I find on the credit side. For wages, we have paid 15,000, but we don't have any prepaid or owing for wages in the additional information. So if you had prepaid or owing for wages, you had to adjust the wages for prepaid and owing. If you look here, we have prepaid and owing in lighting and heating. So lighting and heating is, there's an opening prepaid of 600 and there's a closing owing of 250. For adjusting the expenses, you can use the rule of POOP. So if you use the rule of POOP, so prepaid brought down comes on the debit side. So right here brought down, and prepaid brought down is at the start of the year 600. Then owing carried down will come here on the debit side. So there'll be 250 because it's like prepaid, owing, prepaid, right? So there's a carried down at the end of the year, so that comes on the debit side. During the year, what we paid for lighting and heating was 2,500. So 2,500 you write here on the debit side, and you write here bank. And on the top I write here light and heat. Now the thing is that income statement will come from here, because if you know the format, wherever the bank is, income statement is on the opposite side. Bank is credited, the bank itself is credited when you are paying for an expense, so the expense account should be debited, and you find out the income statement value here. So 2,500 plus 600 plus 250 should give you 3,350. That is the expense for light and heat. So for adjusting expenses, you need to use POOP as a rule. If there was an income, you could have used and they were prepaid and owing an income, so you can use the rule OPPO and make an income account and calculate the income statement value. Yes, so there's no income, so we don't need to worry about that. But now the thing is that every question of incomplete records, whenever we're making the income statement, we don't forget the depreciation that is charged on non-current assets. And if you look here, you have a net book value at the start of the year, that is 40,000, and at the end of the year you have 42,000 net book value for non-current assets. So what you do here is that you need to now you just have net book values. You don't have method of depreciation, you don't have policy of depreciation, you don't have the cost of non-current assets, so you just have net book value. So what you do is that you need to use a net book value formula for calculating depreciation. So net book value formula basically is opening net book value of non-current assets, so opening NBV of non-current assets plus purchase of non-current assets. So purchases of non-current assets, like if you've purchased any during the year, so you'll find that on the credit side of the bank account, and we have purchased 8,000 worth of non-current assets during the year. And then you write as minus sale of non-current assets. So selling price will not come here. This is a net book value formula, so all values must be net book value. So sale of non-current assets minus depreciation. So minus depreciation should equal to closing value of non-current assets. So closing value of non-current asset. So yes, this is the formula that you need to use. Opening net book value is 40,000, which is what we started with. Purchases of non-current assets from the bank account is 8,000. In the first year, the net book value and the cost is the same. So basically, a purchase of non-current asset at cost is also the net book value of this non-current asset that we have purchased. During the year, we sold a non-current asset which had a book value of 1,000. So you need to subtract that. So you subtract that 1,000, and then you minus depreciation, that is minus X. I assume depreciation to be X because I'm trying to find out the depreciation. And then closing net book value of non-current assets is 42,000. Now, if I solve for the value of X, I basically should get 5,000. So that's it for depreciation. So now our information is complete. One thing we are left with is there's a bank loan that we see here. That is at the start of the year, at the end of the year. It's a non-current liability, but we haven't paid any interest on it. If you see, it's a 6% interest on the bank loan. So there's no payment of interest. So what you do is that you basically calculate 6% of the bank loan, that is 20,000. and you get 1200, which will also go in the expenses section of the income statement. Now we've just completed all the information, so everything is there. We have all the values that we can put in the income statement. Now we just use the format and start making the income statement. So we start with the revenue. What revenue will be calculated was 59,150, and then you write here less cost of sales. And then obviously you know the format. You start with opening inventory. So opening inventory will directly come from the question from the opening and closing values. So opening inventory here is 5250, which you start with here. And then you write here add purchases. Purchases I found out from the purchases ledger control account 33,700. We don't have carriage inwards, we don't have purchases returns, so we don't need them. We add them, add these two, and we get here 38,950. And then I write here less closing inventory, of course, because that's the format. Less closing inventory, and closing inventory will again come from the question here. So closing inventory here is 11,000, which I subtract from here 11,000. When you subtract closing inventory, you get 27,950, and you subtract this from the revenue, so you get 31,200, which is your gross profit. Okay, then we don't have any other incomes, so you directly write less expenses, and then you start writing all the expenses. So loss on disposal, which is 250. Then we have depreciation of non-current assets, so that is 5,000. And then we calculated wages. Wages was exactly what we paid, so because wages did not have any prepaid or owing, so 15,000 will be exactly that. You copy here and you write here 15,000. Then lighting and heat. Lighting and heating must be 3350, which we have taken out from the account of lighting and heating, that is 3350. Then we have general expenses, which is 6,000. And then we have another expense which is called interest expense, but right now what they do is that they differentiate from, like they take out profit from operations first, and then you subtract interest expense, and then you get profit for the year. So in the recent marking schemes, you'll see this format that basically interest expense is not subtracted with all the other expenses. You subtract all other expenses, calculate profit from operations, then you calculate and you subtract interest expense, so you get profit for the year. So when you add all these expenses, you get here 29,600, and you subtract this from the gross profit, so you get profit from operations, which is 1,600. You write here profit from operation, and then what you do here is that you write here less interest expense. And interest expense, we calculated it was 1,200. You subtract that and you get 400, that is profit for the year. So this is how we basically first completed the information, and then we made the income statement. So guys, in the next part of this question, you basically need to make a statement of financial position. So what you start with, you guys know already that statement of financial position is based on the accounting equation. You start with non-current assets here, so you write here non-current assets on the top. And non-current assets, you just have one non-current assets, and those are at net book value. There is no specification that what are those non-current assets, so you just take the net book value here and you write here 42,000 directly. Then you have current assets here, so you write here current assets. And current assets, obviously you guys know that inventory, you need to take closing inventory. So basically for the statement of financial position, because I'm making this on the last day of the year, so I need to see the closing value of assets and liabilities at the last date of the year. So you write here inventory closing, that is 11,000, and you write that in the first column, 11,000. Then you write here trade receivables. So trade receivables, in this case at the end of the year, trade receivables in the question were 8,400, so you write here 8,400. And then we have other receivables normally in current assets, which are prepaid expenses and owing incomes, but we don't have prepaid expenses at the end of the year. We don't have owing incomes at the end of the year. We did have prepaid expense at the start of the year, but that's not important because we are making statement of financial position on the last day of the year. So there is no prepaid expense, so there's no owing income. and the bank value is also an overdraft. If you see here, balance carried down is coming here, balance brought down will come here, 10,250, which means it's a negative balance on the bank account, and it's a current liability. It's a bank overdraft, 10,250. So that will go in the current liabilities section. But we just have inventory and trade receivables here. We don't have other receivables, we don't have cash, we don't have bank. So you just add these two and you get here 19,400. So when you add 19,400 and 42,000, you get here 61,400, which is the total assets that you have. The other section of the statement of financial position is the capital section. So you start with capital at start. So we know capital at start is given in the question in the opening values. So we have capital at start 25,000. Then you write here add profit for the year. So add profit for the year, and this will be 400, which is coming from our income statement, profit for the year. So this will be 25,400. Then you write here less drawings. Drawings, we can see drawings are there in the bank account on the credit side, that is 5,000. So when you subtract drawings, that is 5,000 from 25,400, you get 20,400 as your closing capital. Then you write the non-current liabilities. So non-current liabilities, we have one non-current liabilities, that is a bank loan, and we had it at the start of the year, we had it at the end of the year. So you write here bank loan, there's just one, and that is 20,000, and this is coming from the question. And then we have current liabilities. So we write here current liabilities, and basically we have three current liabilities. One, we have trade payables. So trade payables at the end of the year, which is also coming from the question, that is trade payables at the end of the year here is 9,300. And you just write 9,300 as trade payables. Then you write here bank overdraft. So then the next current liability is bank overdraft. That is 10,250. And then we have other payables, which is owing expenses. So we have two types of owing expenses. One is 250 owing for lighting and heating, plus there is 1,200 owing for interest expense, which we did not pay. The whole thing was owing. So this will be 1,450. So when you add these three, 9,300 plus 10,250 plus 1,450, you will get 21,000. So now when you add these three, so closing capital plus non-current liabilities plus current liabilities will give you the other balancing figure, which is also 61,400. So now this statement of financial position balances, and that is basically a proof that we have done everything correctly. It can still balance if you have errors, but if balancing basically is in a way you can tell that you've done things correctly if you're confident enough that you've applied the rules correctly. So that's it for this video. Hope this helps you a lot for your final exams that are coming in May, June 2024. So thank you so much for watching.